Imagine staring at a dashboard where your company is suddenly valued at $160 billion. You are not just building software anymore, you are running the digital infrastructure for the entire planet. Global commerce, international diplomacy, elementary school classrooms, and late-night family gatherings are all funneling through your servers. Your personal net worth is doubling by the week. The media is calling you a visionary, a pandemic hero, the architect of a permanent paradigm shift in how human beings live and work. That was the reality for Zoom in late 2020. But here is the brutal truth about business, that they do not teach you in Stanford MBA programs. A black swan emergency is not an economic moat. It is just an unrepeatable spike in temporary demand. 2 years later, $140 billion of that market capitalization had completely evaporated. The stock collapsed by roughly 90%. And the ultimate devastating punchline to this entire saga happened when the CEO of the very company that defined the work-from-home revolution was forced to issue a mandate ordering his own employees back to the physical office. He had to admit, quietly but clearly, that his own software was not good enough to build the future of his own company. Let's be real. What happened to Zoom is not a simple story of a pandemic stock cooling off. It is a masterclass in the absolute ruthlessness of enterprise software economics, the hidden scaling costs of tech infrastructure, and the fatal mistake of confusing a temporary feature with a defensible platform. We are going to completely tear down the unit economics, the server architecture, and the boardroom panic that led to one of the most spectacular wealth wipeouts in modern Silicon Valley history. To understand why the system collapsed, you have to understand the underlying logic of how it was built. Zoom did not start in 2020. It started out of pure engineering frustration years earlier. Eric Yuan spent years as a vice president of engineering at Cisco, overseeing WebEx. Cisco had acquired WebEx for $3.2 billion back in 2007, and it was the dominant player in corporate video conferencing. But the architecture was a nightmare. It was built on legacy technical debt. If you were a customer using WebEx back then, you remember the pain. Audio dropped constantly. Video lagged. Simply trying to join a meeting required downloading multiple clunky plugins, navigating firewall issues, and praying your system was compatible. Yuan was actually talking to the customers, looking at the data and realizing that the foundational code was fundamentally broken for the modern mobile era. He took these complaints to Cisco leadership, completely mapped out a modernized architecture, and they essentially told him to sit down and keep quiet because WebEx was already a cash cow. So in 2011, he left. He took about 40 engineers with him to build a system from scratch. Now, looking at this through the lens of a financially free Los Angeles entrepreneur, I have seen this exact dynamic play out in a dozen different industries. Bootstrapping a profitable business versus taking toxic institutional money is always the first massive hurdle. When Yuan went out to raise capital, it was not a walk in the park. I remember talking to guys who were in the room during those early days. Picture a high-stakes pitch meeting on Sand Hill Road, going dead silent after a single hard question. The venture capitalists looked at him and asked, "Why the hell are you building another video conferencing tool when Skype, Google, and Microsoft already own the market?" The answer was pure engineering pragmatism. Zoom was built mobile first. It prioritized UDP traffic for video packets to minimize latency, rather than relying on strict TCP protocols that caused buffering delays. It allowed a user to click a single link and instantly join a room without an account. That reduction in friction was their entire wedge into the market. By 2017, they had secured $100 million from Sequoia Capital and hit a $1 billion valuation. But this brings up a massive issue that founders face early on. Dealing with VC term sheet traps like aggressive liquidation preferences and anti-dilution clauses can absolutely gut a founder if the company does not scale perfectly. Zoom managed to navigate this because their capital efficiency in those early days was actually decent. They completed their IPO in 2019, operating as a profitable but relatively niche enterprise communications company. Then the world shut down. Between December 2019 and April 2020, daily meeting participants surged 30 times over. They went from 10 million users to 300 million users in roughly 4 months. Revenue spiked 355% in a single quarter. Wall Street lost its collective mind. The stock went absolutely parabolic, eventually hitting an all-time high of around $568 a share. We are about to look at the actual numbers. So if you appreciate this kind of transparency, hit like to help push this through the algorithm. Now, let us dig into the hidden nightmare that happens when your software scales that aggressively. The public was cheering for the user growth, but any systems architect will tell you that hypergrowth without monetization is a death sentence. Zoom operated a freemium model. Millions upon millions of free users were suddenly logging on for virtual happy hours, digital classrooms, and family calls. But video streaming is incredibly resource intensive. You are talking about massive amounts of ingress and egress bandwidth. Zoom had their own data centers, but they had to rapidly scale up their reliance on public cloud providers like Amazon Web Services and Oracle just to keep the servers from melting down. This brings up a painful reality that I have experienced firsthand in my own tech ventures. The hidden scaling costs of tech infrastructure, especially those insane AWS bills, will bleed out your margins faster than you can blink. During the pandemic boom, Zoom's gross profit margin actually dropped. It fell from their pre-pandemic historical average of around 80% down to 71%. They were paying millions of dollars in server fees to host users who were never going to pay them a single dime. They were bearing real hard infrastructure costs for the illusion of market dominance. And right when the financial gravity of those server costs started pulling at the balance sheet, the foundational trust of the platform began to crack. In November 2020, the Federal Trade Commission knocked on the door. They announced a proposed settlement over massive user privacy issues. For months, Zoom had been telling the public and its enterprise clients that its platform featured true end-to-end encryption. The FTC found that this was simply not true. The company was essentially making misleading claims, giving users a false sense of security while maintaining the cryptographic keys on their own servers. The FTC settlement required Zoom to implement a massive new security program and threatened fines of over $43,000 for every future violation. But the privacy issue was just the appetizer. The main course of their structural collapse was political and geopolitical liability. A month after the FTC action, US prosecutors charged a former China-based Zoom executive named Xinjiang Jin with actively disrupting video meetings, commemorating the 31st anniversary. Prosecutors explicitly stated this was done at the request of the Chinese government. This executive was allegedly operating as a liaison with Chinese intelligence, terminating meetings involving dissidents who survived the 1989 protests, and even creating fake accounts to frame the myth. This was a catastrophic brand failure. Zoom had to admit they were cooperating with subpoenas from federal prosecutors and the SEC for a company that was trying to convince Fortune 500 enterprises and the US government to run their most sensitive confidential communications through their servers, having a direct backdoor link to a foreign intelligence apparatus. Think about it this way. At this exact moment, as these scandals were breaking, the pandemic lockdowns were slowly beginning to lift. Vaccinations were rolling out. The artificial demand was decaying. And this is where we have to talk about the absolute most brutal concept in software business strategy, the threat of the bundle. I was doing some research on audience sentiment today, reading through top financial discussions, and I found a comment that perfectly encapsulated the death blow to Zoom. The user wrote, "My company just got rid of Zoom, and we have replaced it with Teams. We are not cancelling our Microsoft subscription." That is the entire ballgame right there. The contrast between Silicon Valley hype and actual unit economics always reveals itself in the enterprise sales cycle. Zoom was charging companies a standalone subscription fee for video conferencing. Microsoft looked at that and simply integrated Microsoft Teams into the Office 365 bundle that almost every major corporation on Earth was already paying for. Why would a chief financial officer authorize a massive separate purchase order for Zoom when they already get Teams for free with their Word, Excel, and Outlook licenses? They would not. Zoom's leadership team was not stupid. Eric Yuan and his board knew exactly what was coming. They knew their single product status was a massive vulnerability. They desperately needed to diversify. They needed an economic moat, and they needed it immediately. So, in July 2021, Zoom announced a colossal $14.7 billion all-stock deal to acquire Five9, a major cloud-based call center operator. The strategy was obvious. Zoom wanted to take their inflated pandemic pump stock and use it as fake money to buy real sticky enterprise revenue. 59 had an established corporate customer base and a massive footprint in the $24 billion contact center market. If Zoom could close this deal, they would instantly transform from a vulnerable video app into a deeply embedded enterprise communications monolith. I know the mechanics of these deals intimately. The illusion of high paper valuations versus actual free cash flow is never more dangerous than during an MPA negotiation. Picture the scene: big law attorneys reviewing a 100-page M and a contract at 2 a.m. in a Century City high-rise, aggressively marking up the downside protections, because everyone at the table knows the currency. Zoom's stock was the only currency they had to fund a $14 billion purchase, but the market smelled the desperation. As the summer of 2021 dragged on, investors realized that Zoom's hypergrowth was dead. The user base was churning. The stock price started dropping heavily from its peak. And because the 59 acquisition was structured entirely as an all-stock transaction, every time Zoom's share price dropped, the actual dollar value of the buyout offer dropped right alongside it. By September, proxy advisory firms like ISS and Glass Lewis were looking at the cratering value of the deal and telling 59 shareholders to reject it. They warned that taking Zoom stock exposed them to a wildly volatile asset that was entirely dependent on a pandemic that was rapidly ending. On the 30th of September 2021, the 59 shareholders voted the deal down. The acquisition completely collapsed. Imagine that boardroom reality. An emergency Sunday night board call over Zoom with investors screaming on mute. The fastest, clearest path Zoom had to actually becoming a diversified company had just burned to the ground. The falling stock price had destroyed the exact currency they needed to escape their single product trap. It was a self-fulfilling death spiral. Without the 59 acquisition, organic diversification was their only option. But building new enterprise products from scratch takes years, and Wall Street does not have patience. By May 2022, Zoom reported revenue growth of just 12%, their slowest on record since going public. Operating expenses had surged 56% because they were desperately spending money on marketing and sales just to hold on to the customers they already had. They were burning millions on customer acquisition cost while the lifetime value of those customers was plummeting because of Microsoft Teams. By February 2023, the mathematical reality caught up to the payroll. Zoom announced they were cutting approximately 1,300 jobs. That was roughly 15% of their entire workforce. They had hired aggressively, completely misreading the macroeconomic signals, assuming the temporary surge was a permanent shift in human behavior. Now, they were taking massive financial charges just to restructure their operations. Picture employees finding out about mass layoffs via a leaked Slack message, watching their unvested stock options evaporate in real time. Eric Yuan announced he would take a 98% pay cut and forego his bonus, but the structural damage to the company's valuation was already cemented. This brings us to the most fascinating psychological aspect of this entire teardown: the post-mortem and the rebuild. By late 2023 and into 2024, the desperation to change the narrative became palpable. In a move that shocked the tech press, Zoom told its own employees that they were required to return to the office for at least a few days a week. The company that literally built the infrastructure for remote work, the company that spent 3 years preaching the gospel of a decentralized digital workforce, admitted that physical proximity is actually required to build great product. They realized that creative collision, high bandwidth problem solving, and complex engineering architecture require people sitting in a room looking at a physical whiteboard. You cannot build a generational technology company when your entire engineering team is operating in isolated silos across 4 different time zones, dealing with screen fatigue. The RTO mandate was the final nail in the coffin for the remote work utopia that Silicon Valley tried to sell to the public. In late 2024, the company officially dropped the word video from its corporate name. They rebranded from Zoom Video Communications to just Zoom Communications. They are currently attempting a massive pivot into artificial intelligence, desperately trying to integrate AI meeting summaries, generative chat features, and smart scheduling into their platform. They are chasing the exact same AI narrative that Microsoft, Google, and Amazon are pouring hundreds of billions of dollars into. But whether that pivot works or not completely misses the fundamental lesson of the $140 billion wipeout. The problem with Zoom was never that the software was bad. The software was incredible. It functioned perfectly during a global crisis. It kept the economy moving. The problem was human greed, market delusion, and a complete failure to understand basic business gravity. Investors priced a utility like it was a monopoly. They looked at a massive surge in free retail users and assumed those metrics would translate into high-margin enterprise revenue forever. They ignored the fact that any software feature that can be easily replicated and bundled by a larger competitor will eventually be commoditized. Video conferencing turned out to be a feature, not a platform. Zoom spent 3 years and lost $140 billion in market value, learning the difference. The code worked flawlessly, but the business model was always built on borrowed time.